Most men come to the market thinking the secret lies in some clever trick. They imagine there is a hidden indicator, a magical formula, or a mysterious pattern that will make them right more often than wrong. But let me tell you something plainly, because I learned it the expensive way. The market does not reward cleverness. It rewards discipline. You see, improving your win rate in trading has very little to do with predicting the future and everything to do with understanding behavior. Your behavior and the market's behavior. And if you've spent any time staring at a chart, you know the market has habits. It breathes in trends, it hesitates at resistance, and it reveals its intentions long before the crowd notices. But here is the question you ought to ask yourself: are you truly reading the market, or are you arguing with it? I've watched traders lose fortunes because they believed they were smarter than the tape. They saw prices falling and insisted they must rise. They saw strength and decided the move was already over. That kind of thinking does not improve your win rate. It destroys it. The first lesson, and perhaps the hardest one, is this: never fight the trend. A chart is not just lines and candles. It is the footprint of money. When a stock is climbing steadily, making higher highs and higher lows, it is telling you a story. Big interests are accumulating shares. Demand is outweighing supply. The path of least resistance is upward. So let me ask you something. If the market is already telling you the direction, why would you insist on guessing another? Improving your win rate begins the moment you stop predicting and start observing. The chart becomes your guide, not your opinion. Now many traders believe they must trade constantly to succeed. They watch every tick, every candle, and they feel restless when they are not in a position. But the truth is quite different. The greatest profits often come from waiting. Yes, waiting. Does that surprise you? You see, a trader who acts too quickly usually acts without confirmation. He sees a small movement and assumes it is the beginning of a trend. But the market has a habit of shaking out impatient traders before the real move begins. So the wise trader waits for the market to prove itself. When a stock breaks a key resistance level with strong momentum, that is not random noise. That is a signal. When price pulls back gently and holds above support, that too is information. Each piece of price action is a message, and the trader who listens carefully begins to improve his win rate, not through guessing, but through timing. Now let me tell you another truth that few traders like to hear. Your win rate does not improve simply by finding better entries. It improves by eliminating bad trades. Yes, eliminating. Every poor trade you avoid is a victory. Every moment you choose patience instead of impulse is capital preserved. Have you ever entered a trade just because the market was moving and you felt you might miss the opportunity? Most traders have. But the market offers opportunities every week, every month, every year. The problem is not the lack of trades. The problem is the lack of selectivity. Professional traders do not take every signal they see. They wait for the situations that align with their rules. Think of it like a hunter in the woods. Does the hunter fire at every rustle in the bushes? Or does he wait until he sees the target clearly? Trading is no different. When you only take trades that match your criteria, clear trend, strong volume, favorable structure, you naturally increase the probability of success. Your win rate rises not because you are forcing it higher, but because you are filtering out noise. And this brings us to another critical element: risk control. Now listen carefully, because many traders misunderstand this part completely. They believe improving their win rate means avoiding losses entirely. But losses are part of the game. Even the best traders lose regularly. The difference is not that they avoid losses, it is that they control them. Have you ever held a losing trade longer than you should have, hoping it would come back? Most traders have done that more times than they care to admit. Hope is not a strategy. A trader who refuses to cut losses quickly damages his win rate over time, because large losses require many successful trades to recover. Instead, the disciplined trader defines risk before entering the trade. The chart itself tells him where he is wrong. Perhaps the stop lies just below a support level. Perhaps it sits beyond a breakout point. Wherever it is, the rule remains the same. If the market proves you wrong, step aside. Do you see the beauty of that approach? By accepting small losses quickly, you preserve both capital and confidence. And when your winning trades arrive, they have room to grow. Another factor that quietly improves a trader's win rate is something most people overlook: emotional neutrality. The market is a place where emotions can become expensive. Fear makes traders exit winning positions too early. Greed convinces them to overtrade. Pride prevents them from admitting mistakes. But the chart does not care about your feelings. It only reflects supply and demand. So ask yourself this question. When you look at a chart, are you seeing what is actually there, or what you want to see? The trader who learns to detach from emotional reactions begins to see patterns more clearly. He notices when momentum is building. He notices when the market hesitates. He notices when volume confirms a move. Clarity replaces impulse, and with clarity comes better decisions. Over time, these better decisions accumulate. Your entries become more precise. Your exits become more disciplined. Your patience becomes stronger. Slowly, almost quietly, your win rate improves. But there is something else you must understand about this business. Winning trades often require time. Many traders sabotage their own success because they expect immediate results. They enter a position and begin watching every tiny fluctuation as if the fate of the world depends on it. But markets do not move according to your impatience. A strong trend develops gradually. Institutions build positions over weeks, sometimes months. And when you align yourself with that process, you give your trades the opportunity to mature. So let me ask you again. Are you trading the market, or are you trying to force the market to obey your schedule? Because the trader who learns to sit patiently during a healthy trend often sees his win rate improve in ways he never expected. Not because every trade wins, but because the winning trades become meaningful. And as your experience grows, you begin to notice subtle signals that once escaped your attention. The tightening of price before a breakout, the steady climb supported by rising volume, the quiet pullback that refuses to break support. These are the clues left behind by professional money. And if you train your eye to recognize them, your trades begin to align with the larger forces driving the market. That alignment quietly changes everything. Because the moment you stop chasing random movement and start following genuine market structure, your entire approach becomes calmer, sharper, more deliberate. And that is when a trader begins to realize that improving a win rate is not about winning more often in a reckless way, but about becoming so selective, so patient, and so disciplined that the market itself begins to guide your decisions. Most traders believe success comes from finding more trades. They scan dozens of charts, jump from one setup to another, and feel productive simply because they are active. But activity in the market is not the same thing as progress. In fact, the trader who takes too many trades often ends up weakening his own win rate. You see, a high win rate does not come from doing more. It comes from ignoring more. Think about that for a moment. The market produces thousands of price movements every day. Candles form, indicators move, and charts constantly shift. But not every movement carries meaning. Much of what you see on a chart is simply noise, random fluctuations caused by short-term traders, algorithms, and emotional reactions. Now ask yourself this: if you treat every small movement as an opportunity, how often will you end up trading noise instead of real momentum? That is where most traders make their mistake. They believe every setup deserves attention. A small breakout appears and they rush in. A candle forms near support and they feel compelled to act. But the professional trader knows something the beginner does not. Most trades are not worth taking. The market rewards selectivity. Imagine a fisherman casting his net into every patch of water he sees. He might stay busy all day, but his results will likely be poor. The skilled fisherman studies the current, observes the movement of fish, and waits for the right spot before casting. Trading works the same way. The charts constantly offer possibilities, but only a few of them carry the ingredients of a high probability trade. A clear trend, strong momentum, proper structure, and confirmation from price action. When these elements align, the trade begins to make sense. But how often do you truly see all those pieces come together? Not as often as you might think, and that is precisely why discipline matters. A trader who refuses to act until the market shows clarity automatically filters out dozens of weak setups. Every trade he ignores protects his capital and preserves his focus. Let me ask you something honestly. Have you ever entered a trade simply because you were tired of waiting? That feeling is common. The market moves, candles flicker, and the mind begins to whisper that an opportunity might be slipping away. The fear of missing out pushes traders into positions they never planned to take, but the market has a habit of punishing impatience. Many of those rushed trades happen right before the market reverses, consolidates, or drifts sideways. The trader who could have stayed safely on the sidelines suddenly finds himself managing a weak position. This is why discipline is more powerful than prediction. Improving your win rate is not about forecasting every move correctly. It is about positioning yourself only when the odds are clearly in your favor. That means you must develop the ability to sit still while the market does nothing useful. And sitting still can be surprisingly difficult. The mind wants action. It wants participation. It wants to feel involved. But the trader who learns to ignore mediocre setups slowly develops an advantage over the crowd. Because every trade carries risk. When you take 10 random trades, you expose your capital to 10 different uncertainties. But when you take only 2 carefully selected trades, you concentrate your risk on the situations that actually make sense. Over time, this simple shift changes everything. Your focus sharpens. Your analysis becomes more thoughtful. You stop reacting to every small movement and begin waiting for the market to show its hand. You start noticing the difference between a weak breakout and a powerful one. You begin to recognize when volume supports the move and when it does not. You observe how price behaves near support and resistance. These observations are only possible when you slow down. The trader who constantly jumps into positions rarely has time to study the behavior of the market. But the trader who waits develops a deeper understanding of price action, and that understanding naturally improves decision-making. Soon, you find yourself ignoring setups that once tempted you. A breakout without volume no longer excites you. A choppy market no longer pulls you in. You begin to recognize that the best trades usually appear when the chart looks almost obvious. That clarity is rare, but when it appears, the disciplined trader is ready, because he has preserved his capital and his patience by refusing to participate in everything else. And that is the quiet secret behind a higher win rate. Not intelligence, not complicated indicators, not endless screen time, but the calm ability to look at dozens of charts, observe dozens of movements, and say to yourself that most of them are simply not worth the risk, and that the real opportunity has not yet revealed itself. Many traders enter the market believing their opinions carry weight. They study the news, read analysis, and form strong beliefs about where a stock or market should go. Once that belief forms, they begin looking at the chart only to confirm what they already think. But the market has a way of humbling that kind of thinking. You see, the trend is not a suggestion. It is not a theory. It is the market's verdict. It represents the collective action of thousands, sometimes millions, of participants placing real money on the line. And when money speaks in the market, it speaks through price. Look at any chart long enough, and you will notice something simple but powerful. When a market is trending upward, it does not rise in a straight line. It climbs, pulls back, then climbs again. Higher highs form, higher lows follow, and gradually the direction becomes clear. That pattern is not random. It means buyers are consistently willing to step in at higher prices. Demand is strong enough to overcome selling pressure. Large interests are building positions, and the path of least resistance is upward. Now let me ask you something. If the market keeps pushing higher, forming stronger support levels along the way, what reason does a trader have to fight that movement? Yet many traders do exactly that. They look at a rising market and say, "It has gone too far." They assume the move must end soon. They try to pick the exact top, believing they are smarter than the trend itself. More often than not, the market proves them wrong. The trend continues, their position moves against them, and what began as a small opinion becomes a costly mistake. The experienced trader learns to respect the message the chart is sending. If the trend is upward, He looks for opportunities to align with that strength. He waits for pullbacks towards support or consolidation areas where risk can be managed sensibly. He allows the market to confirm its direction before committing capital. This approach might sound simple, but it requires discipline, because human nature encourages us to believe we can outgas the market. Have you ever looked at a chart and thought you knew exactly where it was going next? Most traders have. That confidence can feel convincing, but the market does not reward certainty. It rewards adaptability. The trend tells you where the weight of money is flowing right now. It tells you which side of the trade currently holds the advantage. Ignoring that information is like sailing against a strong current. You may push forward for a while, but the force working against you eventually wins. Following the trend, however, places you in harmony with the market's momentum. Instead of fighting price movement, you allow it to carry your position forward. This does not mean every trade in the direction of the trend will succeed. Markets still pull back, consolidate, and occasionally reverse. But trading with the trend increases the probability that momentum will support your position rather than oppose it. And probability is the trader's greatest ally. Look closely at trending charts, and you will notice something interesting. The strongest moves rarely begin with dramatic explosions. They often start quietly. Price begins forming a series of steady advances, each pullback finding support slightly higher than the last. To the impatient trader, these movements may appear slow or unexciting, but to the disciplined trader, they reveal accumulation. Large investors cannot enter massive positions instantly without moving the market too sharply. Instead, they build positions gradually. Their activity leaves subtle footprints on the chart. Higher lows, consistent support, increasing momentum. These signals are the market's way of revealing its verdict. And the trader who pays attention to those signals gains an advantage over the crowd, because many traders remain distracted by predictions. They try to forecast economic reports, interpret headlines, or anticipate sudden reversals. Their attention shifts constantly, and their decisions become scattered. Meanwhile, the chart quietly continues its story. The trend grows stronger, price moves steadily, and those who simply follow the evidence find themselves aligned with the dominant force in the market. The most successful traders eventually learn a humbling truth. Their opinions are far less important than the direction of price. The chart does not care about what you think a stock should be worth. It does not respond to your arguments or your expectations. It only reflects the balance between buyers and sellers at that moment in time. And when that balance consistently favors one direction, the trend becomes the market's unmistakable verdict. Most people believe the market moves suddenly. They think a stock rises because of a headline or falls because of a piece of news. To the casual observer, it appears as if the movement happens instantly, as though the market wakes up one morning and decides to change direction. But the chart tells a different story. If you learn to read it carefully, you will notice that the market rarely moves without leaving clues behind. Price begins to behave differently. Volume changes. Momentum builds quietly beneath the surface. Long before the public notices the move, the chart is already revealing that something is happening. That is why experienced traders spend so much time studying price action, because the chart is not just recording the past. It is reflecting the present behavior of money. And money, especially large institutional money, does not move in secret as easily as people think. When large funds begin accumulating shares, they cannot buy everything at once. Their orders are too large. If they rushed in all at once, the price would surge sharply and alert everyone. So instead, they build positions slowly and carefully. This gradual activity leaves footprints. Look closely at a chart during accumulation, and you might notice price refusing to fall despite repeated attempts. Each dip finds buyers. Support levels begin holding stronger than expected. The market may move sideways for a while, almost as if it is gathering strength. Now let me ask you something. If a stock repeatedly refuses to fall even when it has the chance, what might that be telling you? It may be telling you that someone with deep pockets is quietly buying. These small signals often appear long before a major breakout occurs. To the average trader, the chart may look boring or stagnant, but to the trained eye, it is showing preparation. Markets move in phases. First comes accumulation, where strong hands build positions. Then comes the markup phase, where price begins rising as demand overwhelms supply. Later, distribution appears as those same strong hands begin selling into strength. And every phase leaves evidence on the chart. That is why charts can reveal intention before the crowd notices. Most traders do not watch carefully enough to see these signals. They wait for the obvious moment. The large breakout candle, the explosive rally, the dramatic news headline. But by the time the move becomes obvious, much of the opportunity may already be gone. The professional trader learns to pay attention earlier. He studies how price behaves around key levels. He observes how volume expands or contracts. He watches the structure of highs and lows forming over time. These observations may seem small, but they tell an important story. For example, imagine a stock repeatedly approaching a resistance level, but failing to break through. At first glance, it may look weak, but if each pullback becomes smaller and buyers step in more quickly, the pressure begins to build beneath the surface. The chart is quietly showing demand increasing. Eventually the resistance gives way, and the breakout appears sudden to those who were not paying attention. But to the trader who studied the chart carefully, the move was not surprising at all. It was simply the result of pressure that had been building for some time. Now consider the opposite situation. A stock rallies strongly for weeks, attracting attention from the public. Headlines become optimistic, and new traders rush in hoping to catch the momentum. Yet the chart begins to behave differently. The rallies become weaker. Volume fades during upward moves but increases on declines. Price struggles to hold its previous support levels. What do you suppose the chart might be saying then? It may be revealing distribution, the quiet exit of large investors who accumulated shares earlier. Again, these signals appear before the crowd fully understands what is happening. That is the advantage of studying charts with patience. They allow you to observe behavior rather than react to excitement. Because the market is driven by human psychology, and psychology tends to leave patterns. Fear, greed, hesitation, and confidence all appear in the structure of price movements. Sharp panic creates sudden drops. Strong conviction creates steady trends. Uncertainty creates sideways consolidation. All of these emotions become visible through price action, and the trader who learns to recognize them begins to see the market differently. Instead of reacting to sudden movements, he notices the build-up that occurs beforehand. Instead of chasing excitement, he observes the quiet signals that often appear when few people are paying attention. Over time, this skill becomes one of the most valuable tools a trader can possess. Because when you train your eye to read charts carefully, you begin to notice that major market moves rarely appear without warning. The evidence was often there all along, hidden in the behavior of price, waiting for someone patient enough to notice it before the crowd finally realizes what the chart had already been saying. Many traders believe the secret to success lies in entering the market early. They want to catch the very beginning of every move. The idea of buying at the absolute bottom or selling at the exact top feels exciting, almost heroic. But the market rarely rewards that kind of ambition. Trying to predict the exact turning point of a market often leads traders into uncertainty. They see a price approaching a level and assume it will reverse. They enter before the market has actually proven anything. And when the market continues moving in the opposite direction, their confidence quickly turns into doubt. This is where confirmation becomes valuable. A trader who waits for confirmation is not trying to be first. He is trying to be right. There is a difference. The market constantly tests levels. It touches support, approaches resistance, forms patterns, and moves in ways that can easily deceive an impatient trader. A breakout may appear convincing at first, only to fail minutes later. A reversal may look promising before collapsing into further decline. Without confirmation, it becomes difficult to separate real opportunity from temporary noise. Now ask yourself something honestly. How many times have you entered a trade the moment you thought the move was beginning, only to watch the market immediately turn against you? That experience is familiar to many traders. The problem is not always the idea itself. Often the problem is timing. Acting too early means placing capital at risk before the market has clearly revealed its direction. Confirmation helps solve that problem. In simple terms, confirmation means allowing the market to prove your idea correct before you commit fully. Instead of guessing that a breakout will occur, you wait until the price actually breaks the level with strength. Instead of assuming a trend will continue, you watch how price behaves after a pullback. The chart becomes your evidence. Consider a stock approaching resistance. Many traders attempt to buy before the breakout, hoping to capture the earliest possible entry. But resistance exists for a reason. It is a level where sellers have previously stepped in. Until the market demonstrates the ability to overcome that selling pressure, the breakout remains uncertain. So the patient trader waits. He watches how price approaches the level. Does momentum increase? Does volume expand? Does the market attempt the breakout more than once? When price finally pushes above resistance and holds that level, the market has provided confirmation. Buyers have shown strength, and the probability of continuation increases. Now let me ask you something. Would you rather risk money on a guess or on evidence? Confirmation does not guarantee success. No method in trading can promise that. But it improves accuracy because it allows the trader to respond to real behavior instead of imagined scenarios. The same principle applies during pullbacks within a trend. Imagine a stock moving steadily upward. Eventually it pulls back toward a support level. An impatient trader may buy immediately, assuming the trend will resume. But the market may continue falling deeper than expected. The disciplined trader observes first. He waits to see if buyers actually defend the support area. Perhaps price forms a strong reversal candle. Perhaps momentum begins shifting upward again. These signals indicate that demand is returning. Only then does he act. This approach may sometimes result in entering a trade slightly later than the exact turning point. But that small delay often removes a great deal of uncertainty. And uncertainty is expensive in trading. Another benefit of confirmation is psychological clarity. When you enter a trade after the market has proven its direction, your decision feels grounded in evidence rather than hope. You are not relying on imagination or prediction. You are responding to something that has already happened on the chart. This mindset reduces emotional pressure, because the trader who constantly guesses feels anxious about every price movement. But the trader who waits for confirmation understands that the market itself provided the signal. That confidence can make a meaningful difference in decision-making. Over time, traders who practice confirmation begin to notice an improvement in their win rate. They avoid many false breakouts and premature entries that once caused frustration. Instead of reacting to every small movement, they allow the market to reveal its strength first. Patience replaces urgency. Observation replaces assumption, and the chart becomes less of a puzzle and more of a conversation between buyers and sellers, where the trader simply waits for the moment when the market speaks clearly enough to remove much of the doubt. Most traders enter the market with one goal in mind: to avoid losing. They imagine success means being right nearly all the time. Every loss feels like a failure, a sign that something went wrong in their analysis or their judgment. But the market does not work that way. Losses are not unusual in trading. They are inevitable. Even the most experienced traders in history have taken many losing trades. The difference is not that they avoided losses. It is that they understood their purpose. Small losses are the tuition of disciplined trading. Think of the market as a place where knowledge must be earned. Every trade carries uncertainty. No chart pattern, no indicator, no strategy can remove that uncertainty completely. The best a trader can do is manage risk and respond intelligently to what the market reveals. And sometimes the market reveals that you were wrong. Now let me ask you something. When the market proves your idea incorrect, do you accept it quickly, or do you argue with it? Many traders argue. They enter a trade expecting a certain move. When price begins moving against them, they hesitate. They tell themselves the market will turn around. They look for reasons to justify staying in the position. But hope is not a strategy. The disciplined trader understands that a small loss is simply information. It means the market did not behave the way he expected. Instead of resisting that reality, he accepts it and steps aside. By doing so, he pays a small cost for the lesson and preserves the rest of his capital. This is why experienced traders treat losses differently than beginners. A beginner often sees a losing trade as something to hide from or recover immediately. He may double down on the position or take impulsive trades to make the money back. But the professional trader views losses as part of the operating cost of trading. Just as a business pays rent, utilities, and wages, a trader pays occasional losses in order to participate in the market.